Here's the most important financial sentence of the week. And it comes from the Financial Times, not from a Reddit post. The current S&P 500 rebound is being driven by the smallest number of stocks on record. Over half of the index's total gains came from just 5 companies: Alphabet, Broadcom, Amazon, Nvidia, and Apple. Charles Schwab. 5 companies out of 500, carrying more than half the weight of the entire index, while the other 495 companies largely did nothing or went down. Over the past month, Alphabet is up 23.79%, Amazon is up 22.74%, Broadcom is up 18.97%, Nvidia is up 16.03%, and Apple is up 11.76%. Charles Schwab, those are extraordinary numbers. And if your portfolio is in an S&P 500 index fund, you are celebrating them. But here is the part that does not make the highlight reel. That concentration is not strength. That concentration is fragility dressed up in a bull market costume. Because when 5 companies carry an index, 5 companies can also drop it. And the distance between a record high and a violent correction shrinks to exactly however long it takes those 5 companies to have a bad quarter simultaneously. Before the Iran war, there were signs of genuine broadening in the market, money moving into value stocks, international equities, and small caps. Now we are back to a situation where the fate of the entire market is tied to an ever-shrinking number of equities. The war did not just spike oil prices. It killed a rotation. It sent money rushing back into the only 5 names investors trust when everything else feels uncertain. And that crowding is now extreme. JP Morgan Asset Management, now let's talk about gold. Because this number is not getting nearly enough attention. Gold futures rose to $4,750 per ounce. $754 to $4.07 per ounce. Charles Schwab. A year ago, gold was trading around $2,300. It has more than doubled in 12 months, and it is not slowing down. Silver at $82 is also a multi-decade record. These are not small moves in a sleepy corner of the commodity market. These are historically significant price levels that are telling you something very specific. When gold and silver move together this aggressively, it is not a trade, it is a signal. Central banks and institutional investors are paying a premium to hold something that is not a dollar, not a treasury bond, and not a tech stock. That simultaneous flight into hard assets while equities are at record highs is the same contradiction we flagged 3 weeks ago, and it is getting louder, not quieter. Now let's talk about the earnings stories that actually tell you where the economy is headed, because this week produced 2 that perfectly illustrate the divide defining 2026. Datadog surged 28% after beating Q1 expectations. The company reported earnings of 60 cents per share against estimates of 51 cents and issued Q2 revenue guidance between $1.07 and $1.08 billion, well above the $993 million consensus. An AI infrastructure company. It is directly in the path of the $751 billion AI capital spending wave. And that spend is showing up in its numbers clearly and immediately. Oxford Economics. Then there is Shopify. Shopify plummeted 15.6% despite posting an earnings beat. The company reported earnings of 36 cents per share, surpassing estimates of 32 cents per share. Stock crashed 15%. Because the guidance spooked investors. Because the market has entered a show-me phase where beating last quarter is not enough. You have to prove the next quarter is going to be better too. And Shopify, which serves small and medium-sized businesses, is starting to reflect what those businesses are actually experiencing right now. Higher shipping costs, higher energy costs, softer consumer spending from the middle and lower income brackets. Shopify is the canary for Main Street, and Main Street is struggling. Oxford Economics, the International Energy Agency, revised its 2026 global oil demand forecast in April, projecting a second quarter contraction of roughly 1.5 million barrels per day, the sharpest decline since the COVID-19 pandemic. The revisions are concentrated in the Middle East and Asia-Pacific markets. The IEA noted that demand destruction tends to spread when energy scarcity persists, suggesting downside risks to the global growth outlook beyond the immediate supply story. JP Morgan Asset Management, demand destruction. That phrase matters. It means the oil price is now so high that it is actually causing economies to use less energy, not because they want to, but because they cannot afford it. That is not a supply problem anymore. That is a global economic slowdown problem wearing an energy price tag. And here's the data point that ties all of this together into a single uncomfortable picture. The New York Fed released a report this week on what economists are now calling the K-shaped economy. The report revealed a troubling reality about wealthy Americans and by extension the market itself. The top of the income distribution is fine. Their portfolios are at record highs. Their 5 AI stocks are up 20% in a month. Their gold holdings are printing. The bottom half is absorbing $4 gasoline, rising grocery bills, a softening job market, and a Fed that cannot cut rates to give them relief. Two economies, one set of stock market numbers. Charles Schwab. April was practically a record month for equities, with one of the strongest monthly returns for the S&P 500 since the Great Depression. Corporate earnings growth was far stronger than expected, and importantly, the strength was broad-based across sectors. But the biggest near-term headwind remains the oil price shock and its impact on inflation and consumer spending. AI Jazeera. Record corporate profits, record gold prices, record market concentration, record consumer pessimism. All simultaneously. In the same economy. In the same week. Rate cuts are now off the table until well into 2027. The Iran war and oil-induced inflation have shot much higher, and the Fed is not moving until that picture changes meaningfully. Which means small-cap stocks, rate-sensitive sectors, and anyone counting on cheaper borrowing costs to grow a business or afford a house is looking at an extended holding pattern that has no clear end date. Wikipedia. Here's the bottom line. The market is at record highs because 5 companies are at record highs because AI spending is at record highs. Everything else, the Shopifys, the small caps, the working-class consumer, the job market below 100,000 monthly additions, the gold and silver surge, the demand destruction in oil markets, is telling a very different story running parallel to the headline number. The question is not whether this concentration ends. All extreme concentrations end. The question is what the catalyst is. Is it a bad Nvidia earnings on May 20th? Is it the Iran peace deal falling apart completely, and oil spiking above $120? Is it the jobs report showing the labor market has deteriorated faster than anyone publicly admitted? Or does the AI earnings wave prove strong enough to hold the whole thing up through year-end while everyone else quietly treads water? 5 stocks. 500 in the index. Do you think the other 495 catch up, or do the 5 finally come down to meet them? Drop it in the comments because that answer determines what the rest of 2026 looks like for almost everyone's portfolio.